The Federal Reserve's worst nightmare could be happening in the economy right now, and that worst nightmare is stagflation. We're seeing more and more reports about stagflation across the economy, and this is something that you all need to pay close attention to. Because in economics, stagflation is a situation in which the inflation rate is high or increasing while economic growth slows and the unemployment rate remains steadily high. Something that's every central banker's worst nightmare. Jerome Powell, he's losing sleep over this right now. And really why you need to be concerned about this prospect of stagflation is because if it happens over the next several years, that's going to mean huge problems for the economy as well as the stock market and the housing market. It's likely going to mean a huge collapse in asset values and the unemployment rate skyrocketing to as high as 10%. Now, I'm not saying that that's definitely going to happen. However, you out there, you need to understand the risk factors because more and more the US economy in 2024 is starting to look like the economy that we were experiencing in the early 1970s. And you can see that on this graph where we're comparing the inflation rate in the last several years, the blue line, to what the inflation rate was in the late 1960s into the early 1970s. And what do you see is that heading into the 1970s, we experienced multiple surges in inflation, 3 separate peaks that resulted in inflation getting as high as 15% per year by the early 1980s. In the 1970s, we saw an entire decade of crazy inflation, double-digit inflation, where the dollar lost an astounding 70% of its purchasing power in just one decade, everyone. We don't want to see this happen again. And the concern among many US consumers right now is that we could. Because the consumer sentiment surveys across America, when they go out and ask people how they're feeling about the economy, more and more consumers are saying we're scared that inflation is about to pick back up. With US consumer sentiment just dropping to a 6-month low on inflation and unemployment fears, everyone, this is a big drop in consumer sentiment over the last month or two that signals we could have problems in the economy over the next year. Let's take a look at what this had to say. The University of Michigan, their consumer sentiment index released on Friday, dropped to 67.4 this month from a final reading of 77 last month, down 13% month over month, with a broad consensus across consumers expressing worries that inflation, unemployment, and interest rates may all be moving in an unfavorable direction in the year ahead. And so this consumer sentiment, everyone, it's a big factor in the health of the economy because ultimately it's consumers and consumer spending that supports the economy. 70% of US GDP, it's consumer spending. So if we see the consumer sentiment collapsing due to inflation and unemployment fears, well, we have to take a closer look at the underlying health of the US economy and see if it's really faring as well as people think. And one really interesting aspect about this consumer sentiment survey is that they broke out the consumer sentiment by how people hear news about the economy. And this is just so interesting, everyone. Pay attention to this scatter plot. It shows that in the bottom left corner, those who derive their news from the economy based off personal experiences have by far the worst consumer sentiment, an index level below 60, which is on par with a depression. Additionally, those who get their news about the economy from word of mouth also had a pretty negative sentiment as well, while those who get their news on the economy from business and mainstream news sources, they have a very positive sentiment on the economy, thinking that it's in an economic expansion. And so this is crazy, everyone. Like there's this big debate right now about like what is actually going on in the economy. And no one can seem to agree. You know, you have some people saying like, oh, the stock market is booming and the housing market hasn't really crashed yet, and the unemployment rate's low, and you know all the mainstream news sources are saying good things, so it's good. But then you have other people who might be laid off or lose their job or hear about their friends who get laid off or just kind of see their earnings shrinking, or maybe they own a business and they're seeing tough times. You have these people based off personal experiences and word of mouth saying, no, 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 no. This economy is not that strong. indicating, according to the University of Michigan, that some consumers appear to have experiences or know of others who have experiences within the economy that diverge from the more positive portrayals noticed by consumers following mainstream or business news sources. And what this causes me to think, everyone, is that the underlying health of the economy is not that strong. And that at some point, when the mainstream news sentiment changes in a negative direction, and I don't know like when that's going to happen, but when it does, is when we'll see the shoe drop in terms of layoffs, in terms of stock market crash, in terms of housing market crash. And when that happens is likely going to be when the unemployment rate really starts to spike. Because interestingly, right now, everyone, the unemployment rate is at a historically low level. It's only 3.9%. You can see that this 3.9% unemployment rate, it's up from where it was about a year ago. You can see it's starting to trend up, but it's still at a very low historical level. And what has me concerned when I look at this 70-year unemployment rate graph is that when we see the unemployment rate start to trend up historically, what do you notice is that it'll trend up for like a year or a year and a half. And then after trending up for a year and a half, it'll then explode. Like all at once, the layoffs will just start really happening. And this is something I think a lot of people are forgetting about the business cycle in America, is that it's not as if, it's a easy linear path to a recession and big unemployment and a huge crash in the stock market. It's something that kind of comes about slowly at first and then spikes. And what will be really interesting to see is when the unemployment rate inevitably does spike, say it's maybe, at or after the election later this year, what's going to happen to the inflation rate in America when the unemployment rate spikes? Because what happens to inflation when unemployment rate spikes is going to have a huge impact on asset values and the long-term health of the economy. Because historically, there's an inverse relationship between inflation and unemployment. And when unemployment goes up, it typically means inflation should go down. And when inflation goes down due to higher unemployment, that's what allows the Fed to cut interest rates in a recession. The Fed usually cuts interest rates in a recession due to the fact that a declining inflation rate allows them to do that. However, in the case of stagflation, the Federal Reserve doesn't have that option. And that's why the prospect of stagflation, which I mentioned in the beginning, is so dangerous and one that you need to focus on. I want you folks to look at what happened in the 1970s. We have two lines on this graph. And the blue line is the inflation rate, the red line is the unemployment rate. We can see that in the 1970s, for instance, back in 1975, we had an unemployment rate of 9% with an inflation rate of 12%. And so that combination, folks, is a nightmare. Because when the inflation rate is double digits and the unemployment rate is double digits, it's like, what does the Federal Reserve do? Because on one hand, they want to cut rates to help the job market, but then they can't cut rates because inflation's too high. This is why the 1970s economy was so bad and why Jerome Powell is having nightmares about the idea of stagflation. You can see this also happened back in the late 70s into the early 80s. We had 15% inflation to go along with 8% unemployment. This is a scenario that more and more people are thinking could repeat in the 2020s. In particular, everyone, JP Morgan Chase CEO Jamie Dimon, someone who I've talked about a lot on this channel, he's recently expressed concerns that the US economy looks more and more like the 1970s than we've seen before. Now, if we do see a repeat of the 1970s economy in America, where we had double-digit inflation and double-digit unemployment, that presents some very interesting ideas about what you should do from an investment perspective. Because the typical investment playbook in terms of stocks and housing and bonds, a lot of that goes out the window in a period of stagflation because we're not operating under normal economic circumstances. For the longest time, economists actually thought stagflation was impossible. And so there really isn't much well understood about what to do in such an environment. But, one thing that seems pretty certain is that if that were to happen, the stock market would collapse. Because the stock market today, it's in a massive bubble, one of the biggest bubbles of all time, with the 100-year graph of the S&P 500 showing just how ridiculous today's current stock prices are. The value of the S&P 500 today, it's approximately 5 times higher, almost 5 times higher than it was a decade ago. This is absolutely nuts. It shows how, anyone banking on the value of your 401k, holding its value over the next couple of years. Just look at this graph and see if that seems sustainable to you. I'm not a stock market predictor, but a picture tells 1,000 words here. And really, the reason that the stock market's so high right now is because of this fairy tale land people have envisioned of low interest rates, low inflation, and low unemployment, right? That's basically what we had for much of the last 10 years. However, the prospect of stagflation completely annihilates this type of bubble, because we would shift into having high interest rates, high inflation, and high unemployment. And you can see that during the 1970s in America, it was a very bad decade for stocks, with the real value of the S&P 500 collapsing by over 50% across the decade. So inflation adjusted stock market returns minus 50% in the 1970s, in the last period where we had stagflation. Now, interestingly, the housing market in the 1970s performed much better than the stock market during that period of stagflation. In fact, home prices in the 1970s, they more than doubled in nominal terms, with the typical value of a house going up from $23,000 in 1970. If you can believe it, everyone, you could buy a house for $23,000 in 1970, all the way up to $57,000 by 1980. So if you bought real estate in the early 70s, you did pretty well throughout the decade in nominal terms. Now, of course, in inflation adjusted terms, you didn't do as well. Your inflation adjusted home price by the end of the decade was only about 6 or 7% higher than it was at the beginning of the decade. And so this, speaks to how destructive inflation can be for an economy, right? Even one of the best performing asset classes in the 1970s, housing, just barely even kept pace with inflation while stocks completely cratered. Now, I don't actually believe housing is going to perform as well in another stagflation environment, say in the 2020s. And that's because home prices are already just like way too expensive relative to underlying incomes and underlying inflation levels today. Back entering the 1970s, home prices were actually really cheap in America, and so they had room to grow. Today, they're not cheap at all. With the typical home value to income ratio in America today being 4.5, houses trade for around 4.5 times the median income. Back in the early 1970s, before that great decade of inflation, the home value to income ratio was only 2.7, and it never even got above 3.2. And so this speaks to the fact that housing is just like so expensive today in a way that it really has never been expensive before. And so I actually think home prices would actually crash here in 2024 and beyond if stagflation happened again, because I don't think the housing market or any other part of this economy is prepared for a big rise in the unemployment rate. Like, a lot of people seem to think that our economy is resilient and asset markets are resilient, but they've been resilient so far with a sub 4% unemployment rate. I mean, think about that, everyone. When the unemployment rate gets to something like 6 or 7%, or maybe even higher, that will change the ball game on everything. Consumer demand will be much lower. People's ability to afford rent and mortgages will be much lower. Defaults will increase. And inventory, I think, is going to skyrocket across all sectors of the economy if we see a stagflation-like scenario play out. Now, one way that you folks can kind of track this for yourself month by month to see if we're entering stagflation and to see if you need to start preparing for it is to look at a data point called the misery index. And this misery index, it does a really good job of very simply showing you how tough the economy is for Americans. This misery index is a measure of economic distress felt by everyday people due to the risk of joblessness combined with an increasing cost of living. It is calculated by adding the adjusted unemployment rate to the inflation rate. So that's it, everyone. Take the government reported unemployment rate and add it to the government reported inflation rate, and you get a quick and dirty measure of how bad the economy is at a given moment. And you can see, going back the last roughly 70 to 80 years, the average misery index in America has been 9.4. So on average, the sum of the unemployment and the inflation rate has been 9.4. We can see that during the massive inflation of 2022, this misery index got up to 12.6, which was pretty high. However, now it's down to 7.3, a 7.3 misery index based on the sum of a 3.4% inflation rate and 3.9% unemployment rate. So very clearly, you can see that we are not yet really even close to what you would call like a significant stagflation environment. We would need to see this misery index go up first into double digits and then closer to maybe 12 to 15% before you could start calling for stagflation. Now, back in the 1970s, you could see just how bad the situation got due to this misery index, with it peaking at 20% in 1975 with an inflation rate of 11.8% and an unemployment rate of 8.1%, and then up to 22% misery index in 1980 due to a 14% inflation rate and a 7.5% unemployment rate. And so again, this just underscores how bad the 70s and early 80s was for our economy. This was stagflation right here. This is the textbook definition of it, and it's something that is a definite risk factor for our economy into the future based on how we're seeing growth slow and inflation pick up. However, we are not there yet, but it doesn't mean we won't be soon in the future. As I talked about in the beginning of this video, the underlying economy is likely much weaker than the mainstream perception of that economy. Remember, people who are reporting based on their personal experiences and word of mouth in the economy, they are saying things are pretty bad right now. Especially those people reporting on personal experiences, they're saying we're already in a deep recession or depression. While those getting their economic information from the stock market, business news, and mainstream news, they have a much stronger impression. However, I think this is more indicative of what's truly happening and what will happen in the future. And track the misery index month by month. I'm going to have a link in the description to a website where you can track this month by month and you can see if the economy is getting worse and approaching the stagflation that we saw of the 70s and 80s.